Welcome to this Killik Explains finance video. This week, why are investors suddenly worrying about the yield curve and the US yield curve in particular? Well, let's take a look. So, in a nutshell, the US yield curve is currently pretty flat. You think, how can a curve be flat? I'll show you that in just a moment. It's a term of jargon. So, this means that short and long-term yields are pretty similar. Diagram coming up. There's disagreement about whether that's good or bad news. I'll explain why in just a moment. As ever, signals like this need interpreting. So, how worried should you be? Well, let's take a look. Now, a quick snapshot. So what do I mean by a yield curve? Basically, at the moment, it looks something like that. So, what is this thing? Just a quick reminder, this is not a video on yield curves, it's about interpreting them, but what are they? So, basically, what these things do is they plot the relationship between the yields on what could broadly be called short-dated, sort of medium-dated, and then long-dated government IOUs. Doesn't have to be government IOUs, but we're looking at the US Federal Reserve yield curve at the moment, so US Treasuries are in the spotlight, if you like. And essentially what it's saying is, well, a normal upward sloping yield curve, if you like, would see short-term yields below longer-term yields. Why? Because if you think about it, if you want to lock your money up with the government for 30 years rather than, say, 3 months, you could expect to receive a higher return in the form of a yield for doing so. Because otherwise, why would you lock your money away? You're doing the government a favour. So, that is roughly how the yield curve looks at the moment. It's so-called normal upward sloping. Now, what's been happening is this. There's the one, all right, as it looked back in December 2016, slightly flatter, if you notice that. And there's the one as it looked in December 2013. All right, so what you've got is a pattern of the yield curve changing and sort of flattening over time. And what people worry about is this. You can see that it's moving up like that. What people are worrying about is this. If it turns into this shape, and that, if you can't read the graph there, is the shape it was just ahead of the credit crisis or the credit crunch, and that's inverted, that's where this end is actually slightly higher, if anything, than this end. You've got a little bit of inversion there. That, as we now know, is bad news. So the fact that the yield curve changes shape ahead of trouble has got some people worrying that, wait a minute, isn't it moving slowly from where it was, let's say, a few years ago here to more like that shape? And does that mean another crisis lies ahead? So let's try and answer that question. Now, yield curve basics first of all. For anyone thinking, what is that thing again? Yields, what are they? Very quickly, the total annual return as a percentage of the current price. So what? Well, as bond prices rise, fixed income yields tend to fall and vice versa. And they're quoted for different maturities, short, medium and long. Now, a normal yield curve is upward sloping. Why? Investors expect to be rewarded for taking time risk. Yields are therefore higher on long-dated bonds, hence on my graph, the normal situation being the 30-year part of the graph is above, say, the 2-year, and this creates the upward slope. What's making people nervous is that when that slope starts to flatten, will it go the other way and invert? Now, bulls would say no problem. There is no problem with a flat curve. If you look back historically, a flat line, a US Treasury flat line, has not always been associated with trouble. Why not? What could be happening now? Well, bulls will say, as the Federal Reserve raises short-term interest rates, which it has been doing, the yield on short-dated bonds will naturally rise too. Why? Because with fixed income securities, I cover this in my videos called What are Fixed Income Securities, as interest rates rise, fixed income bond prices tend to fall, and that increases their yield. So what's going on is just a natural reflection of what the Federal Reserve's been doing recently. Okay? Rising rates by the Federal Reserve are a signal the economy is strengthening, inflation and growth are returning. Why worry? It's not a problem. But there are bears out there who are saying, no, a flat curve could turn into an inverted one, and inverted ones are usually signalled trouble ahead. Investors have abandoned their time preference. What's happening is investors are saying, I don't care. I'm prepared to invest for a much longer period, abandon my normal demand for a higher yield because I'm worried. I'm seeking safety in longer-dated bonds. Why would you be doing that? Well, if you expect growth to collapse, inflation to fall, and interest rates to start falling again to stimulate growth, you're prepared to lock your money up for longer in something that pays a fixed yield, even if you sacrifice that time preference in the process. All right? So, bad times lie ahead, and investors in the bond market are signalling it. Why are we paying attention to people in the bond market? Well, because Bond market investors are thought to have a better track record when it comes to predicting trouble and good times than, let's say, equity investors. Now, you can disagree on that point, but there you have it. So, which is right? Who knows? Got to make up your own mind, but it just goes to show people do watch this thing called the yield curve and they watch it closely. A lot of science compressed into one video there. To find out more, editor@killik.com. And if you'd like to find out more about bonds and fixed income securities before worrying about what's in this video, please go to killik.com/learn and click the bonds tab.